3 months ago, the MPC said that an ongoing tightening of monetary policy over the next few years would be appropriate to return inflation sustainably to its 2% target. That guidance was explicitly conditioned on the economy evolving broadly in line with the committee's February inflation report projections. In the period since then, the economy hasn't fulfilled those conditions. Growth at 0.1% in the first quarter of this year was much weaker, and inflation at 2.5% in March was notably lower than we had projected in February. The key question is whether this softness will prove temporary or persistent. In other words, was the weakness in the first quarter due to the weather or the climate? The MPC's central assessment is that it largely reflects the former, and that the underlying pace of growth remains more resilient than the headline data suggest. The period of adverse weather hit construction particularly badly, and it weighed on activity more broadly as people struggled to work and to make it into the shops. In contrast, the labor market has remained reassuringly strong. In the 3 months to February, employment rose by more than we had projected, and the unemployment rate fell to 4.2%, the lowest rate in over 40 years and a touch below the MPC's estimate of the natural rate. Private sector wages have picked up. Adding to the positives, job-to-job flows are back to their pre-crisis averages, and there's widespread evidence in employment surveys of a tightening labor market. The overall economic climate in the UK looks little changed to the MPC thus far. In particular, we have long forecast a rotation in demand towards net trade and business investment and away from household consumption. This is what has happened, and we expect it to continue. UK exporters remain in a sweet spot, with sterling down 15% in anticipation of a Brexit that has not yet happened, particularly with a new transition agreement that extends unfettered access to EU markets until the end of 2020. Although they've eased slightly, the European and global economies are growing faster than trend and are projected to remain robust over the forecast period. As a consequence, net trade is projected to continue supporting UK growth over the next few years. Turning to business investment, evidence of both the bank's decision-maker panel of 3,700 firms and our direct contacts across the country indicate that the drag from Brexit uncertainty, while persisting, has not intensified. With continued support from strong external demand, limited spare capacity, the relatively high rates of return on capital, and the low cost of finance, business investment is expected to continue to expand at a moderate annual rate of around 4% over the forecast period. On the consumer side, although there's been some reduction in the household savings rate since the referendum, this has been far from a debt-fueled consumption boom. Rather, household spending has broadly tracked income and employment growth. There is somewhat greater uncertainty about the near-term momentum in consumption spending, given the recent weakness in consumer credit and the housing market, with the possibility that households could opt to save rather than spend as their real incomes recover. On balance, though, with the real income squeeze coming to an end and the adverse weather behind us, consumption growth is projected to recover over the forecast to rates broadly in line with the subdued pace of real income growth. Let's put that in some context. The MPC is expecting household consumption to grow over the next few years at about only half the rates prior to the referendum and merely 1/3 of the rates prior to the global financial crisis. So overall, the climate is one of modest demand growth with a combination of solid growth in net trade and moderate growth in business investment, offsetting more subdued growth in household spending. These judgments leave the MPC's latest projections broadly similar to those published 3 months ago. In particular, GDP growth is projected to pick up after the weak first quarter to annual rates of around 1.75% throughout the forecast period.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.